Good afternoon, everyone, and welcome to this webinar presented to you by the Mon Markets Academy from the Mon Markets. Now, whether you are completely new to trading, curious about how financial markets work, or someone who has already started exploring the markets but still feel overwhelmed by all the information online, this session is designed for you. Today, what we will do is we will simplify the world of financial markets and break things down step by step in a practical and beginner friendly way. We'll discuss what financial markets actually are, why prices move, the different asset classes traders invest in, the difference between investing and trading, and the key foundations every beginner should understand before placing their first trade. The goal of this webinar is not to promise shortcuts or overnight success. Instead, we aim to help you build a clearer understanding of how markets function and how traders should approach them. My name is Habib Akiki. I am the Director of Research and Market Education with Daman Markets. I have a bachelor's degree in banking and finance, a master's degree in financial management from Bocconi in Milan, Italy. Uh, I'm also a certified technical analyst from the International Federation of Technical Analysts, and I have over 17 years of experience trading the international financial markets and working with uh, top financial institutions in the region. I'm from Lebanon, residing in Dubai now, and happy to be hosting this webinar. I believe I will be able to assist you in whatever you need. So please do not hesitate to drop down your questions in the Q&A window, and I'll make sure to answer all your questions. If not through this presentation, by the end, we will have a 10-15 minutes Q&A segment. So I'll definitely answer all your questions. All right, so let's start by exploring the reason why people trade. Of course, most of you here are interested in the financial markets because you hope to make money out of this. So yes, people might have different reasons to trade, but it all comes down to earning some profits. Now, the financial markets is the place where financial assets such as stocks, commodities, bonds, currencies, and cryptocurrencies are traded. Now, some people are motivated to trade because they expect to gain some profit out of their investments. Now, we call those speculators. Ahmed is asking if we can do this webinar in Arabic. Unfortunately, Ahmed, ما راح نستطيع نتكلم بالعربي لأنه هذا الويبينار was advertised as an English webinar. However, tomorrow غدا عندي ويبينار بالعربي، فبتمنى انك تسجل بهذا الويبينار. وغدا الساعة 8 بتوقيت دبي، 7 بتوقيت السعودية، رح يكون في عنا ويبينار بالعربي. فهلا بفرجيك من وين ممكن تسجل على هيدا الويبينار. ضمان ماركتس اكاديمي، رح تلاقي هيدا الويبينار معلن عنه وممكن تسجل عليه. Excuse me for Arabic, guys, but I had to answer Ahmed. Okay, going back. So a lot of us trade because we want to make money out of this. Now, those who aim to buy low and sell high, or sell high and then buy at a lower price, those are speculators. They try to anticipate price movements and trade to make profit. As I said, by buying low and selling at a higher price, or selling first and then buying at a lower price. And yes, this is possible in the financial markets. You can sell something that you don't yet own and then buy it at a cheaper price. I will be explaining more about the short selling later on during this webinar. Now, other people are motivated to trade in order to manage their risk. We call them hedgers. Hedgers trade in order to protect an asset they already have, like a farmer who sells his crop before the harvest season, or the jewelry shop the jewelry shop owner, basically, his main craft is craftsmanship. His real business is selling jewelry designs and craftsmanship. So he's not benefiting from gold prices going up. Now imagine the jewelry shop. He needs, let's say, 1 kilogram of gold for the next month. He will buy pure gold, and then he will transform the pure gold into necklaces, bracelets, and jewelry. Now, when you go to a gold shop, to a jewelry shop, and you want to buy something, a piece of jewelry, the shop is will have to sell you at the current market price. So if we look at the platform now, if we look at the price of gold, we can see that the ounce of pure gold is now trading at $4,694. And that's the price of 1 ounce. So 1 ounce is around 31 grams. So if you divide 4,700 by 31, 1 gram of gold is around $150. Now, if you go to the shop is forced to sell you, will have to sell you the gram at $150. Because if he don't sell you at this price, even if imagine he bought it for $200, the gram, he cannot sell it to you for $200 because then you will go to the next jewelry store and you will buy it at the market price, which is $150. So because he is forced to sell it at the current market price, he needs to hedge his risk. Now, if he bought this 1 ounce of gold at $4,000 and the price of gold went up, he will profit, right? He will sell you at, let's say, 5,000, and he will make extra profit because the price of gold went up and he bought it for 4,700 and now it's priced at 5,000. However, prices go up, but they might go down as well. And this is where the problem comes. Imagine this same jewelry store buys gold at 5,000 and today the price is 4,700. Now for the craftsmanship and for his skills, he might charge you $10 or $20 for each gram, and that's his profit. If the price drops from 5,000 an ounce to 4,700, he will basically lose money just because the price of gold went down. How does he eliminate or neutralize this risk? The moment he goes and buys 1 kilogram of gold, he sells the same equivalent amount on the platform in the financial markets. Now, if the price of gold goes up, he will lose on his sell position, but he will earn the difference in the physical gold he's selling to his clients. Now, the other way around is also true. If the prices of gold drops, he will lose in the physical gold he bought at a higher price, and now he's forced to sell it at a lower price, but his position in the financial markets will make up for him the difference. Now, we are talking here about the jewelry shop, but this also applies to all companies. All international, global companies hedge their risk. So people trade to either to speculate and make profits out of their trading or investments, and others, called hedgers, trade to simply manage their risk. Now, financial markets are categorized by the assets traded. So let's go over the different types of financial markets. The equity or the stock market is where you can buy and sell shares of companies like Apple, Facebook, Alibaba, Coca-Cola. Okay, all the companies that you know, all the big firms that you know, most of them are listed on stock exchanges, and basically the equity or the stock market is where you can buy and sell these shares. The foreign exchange or the forex market is where you buy and sell currencies like the euro, the dollar, the Japanese yen, the British pound, and so on. The commodities market is where you buy raw materials, commodities like gold, silver, oil, grains, sugar, cotton, orange juice, and even cattle. And we have the bonds market or the fixed income market where you can lend money to governments and corporations. And last but not least, we have the derivatives market where you can simply trade financial contracts that derive their value from an underlying asset. We will go over each type of financial markets, starting with the equity market. The equity market or shares market is simply the place where shares or stocks are traded. Shares of publicly listed companies like Apple, IBM, Coca-Cola, Tesla, you name it, are traded usually in a stock exchange, like the New York Stock Exchange, London Stock Exchange, Tokyo, and so on. Now, if a company is profitable at the moment and expected to make more profits in the future, the price of its share will rise. The value of the company will go up, and every single stock of this company will increase in value. Of course, if the company is not profitable at the moment and is not expected to make future profits, then what happens is that its valuation will drop. The value of its shares and stocks will drop. Now, every one of us, I'm sure that at some point considered opening a side business, whether it's a small restaurant, an agency. He thought of buying something and selling it at a higher price. I don't know. I'm sure that we all looked into different ventures in order to, with the purpose of earning more money. Okay. Now, one thing that every investor should consider, instead of going and opening his own company or his own business, we should always consider partnering up or buying shares in already established and successful companies. Now, a share represents ownership in a company. So if you own a share of a company, you are a part owner. Of course, if you own one share in Apple, you won't be a big owner, okay? But at least you own a small part of this company. Now, as a shareholder, you have the right to vote on who runs the company and other important matters, like selling the company, for example, or buying another company, acquiring another company. Now, of course, these things are important, but what matters is you want to make profit. If this company makes profit, you, as a shareholder, you also earn a part of this profit, equivalent to the shares or percentage that you own. Now, in the long run, shares offer better returns than government or corporate bonds. They offer better returns than property and many other types of investments. This is one reason why you should invest in shares. Looking here at this chart, this is the chart of the S&P 500. Okay, and I'm going to explain what is the S&P 500 in 1 minute or 2 minutes. Basically, think of it, this is the chart of the US stock market, of 500 companies in the US stock market. And look at this trend. What can you see? We are looking at a chart representing almost 45, 47 years from 1981 up to 2026. And what you can see here is that the price is going up. So you can notice a clear uptrend. And this is the economy. These companies represent the US economy. And the US economy, like any other economy, usually what happens is economies grow, population grows, companies grow, and so the economy in general. That is why it's very important to always consider investing in successful companies rather than going and taking your own risk, opening your own company. Uh, it is always easier and sometimes even more profitable to just go and buy a small share of an already successful business. This is one reason why you should invest in stocks. Another reason is, as I told you, by becoming an owner of the company, you get a share of the profits this company generates. This is what is known as dividends. So every 3 months, these companies will release their earnings, will publish their earnings, sales, costs, and how much profits they made. Of course, if they have plans to expand their business, they will use these profits and reinvest them to grow the business. However, some companies will decide that, okay, now we need few millions and the remaining profit we will distribute to our shareholders, to our partners. And this is what is known as dividends. So if you own a share, you also own a share of the profit that this company generates. If the company is profitable, the price of its share will also go up and you will make profit. This is known as capital gain. So when you invest in a company, you can earn profits uh, from dividends and also from the capital gain, which means that the difference in the price that you bought and the price that you can sell at the moment. Okay. And it's very easy to buy shares. All you have to do is open a trading account with a financial institution, like the bond markets, for example. And then you can choose to invest with companies that you like. You like their products. So if you like Apple as a company, you have an iPhone, you always own an iPhone or a MacBook. You believe that Apple will continue to grow, will continue to release good products in the market, then you would say, okay, I'm going to be an owner, a part owner. I'm going to own a share of this company. If you believe that NVIDIA will grow more and benefit from the products and the chips that the company is producing, you can say, okay, I don't know a lot about AI and tech. I can't open my own company, so I will buy a share in NVIDIA. The same with Tesla or Coca-Cola or Pfizer or any other company. You can buy a share of American Airlines, for example. This is regarding the stocks. Now, of course, investing in individual companies has proven to be a very good investment. But someone might argue that, Habib, if I go and put my money in one company and then this company goes bankrupt for one reason or another, this is a big risk. Well, yes, this is a risk, but this is a risk that you can mitigate by diversifying your investment. So instead of going and putting all your eggs in one basket, instead of putting all your investments in one company, what you can do is you can split your money or capital and buy in many, many companies. Now, the easiest way to diversify your investments is to buy a stock index. The index is similar to a fund, to a bouquet of stocks, a group of stocks. Indices summarize the performance of major groups of stocks. Indices are calculated by finding the average price of the stocks within this group. So let's take an example, the Dow Jones Index. The Dow Jones 30 Index is calculated using the closing prices of 30 of the biggest companies in the US stock exchange. You have the UK 100 or the FTSE 100, which averages 100 shares in the UK exchange. The Nikkei 225 is made up of 225 companies in Japan. So imagine you can do your stock picking. You can pick some companies that you are interested in investing in, or you can say, I'm not interested. Okay, I just want to buy the whole market. If you look at the chart of the US stock market, it's in a it's in an uptrend. It is growing over the years. So I don't want to go into the trouble of picking individual stocks. The easiest way is to go and buy the whole market. I want to get exposure on the whole market. You can do this through stock market indices or exchange traded funds. Exchange traded funds is you buy funds specialized in one sector, for example, or you can do the same through stock indices. Taking you back to the platform, here we can have a look at the chart of the S&P 500 index, which represents the price of or the value of 500 companies in the US market. So basically, this is the best representation. This index is the best representation of the US market, of the US stock market, or the US economy, if you want. And look at this chart. This is the chart from 2015, so almost 11 years. And you can notice that it's going up. Back in 2015, the value of the S&P 500 was 1,800, yes. Now it is trading at 7,400. Of course, it didn't go up in a straight line. You can see here that in 2019, for example, the market dropped, or this index dropped in value from 3,400 all the way to 2,200. So almost 36% drop. But what happened after? The market recovered, and then it reached new highs. And of course, back in 2022, beginning of 2022, the market dropped again. And this time the market dropped around 27%. And in less than 2 years, the market recovered again and went into new highs. And again, during the tariff war, when Donald Trump became president for the second time, the market dropped another 22%, but it recovered, and now it's going to new highs. And this drop. This is the latest drop that happened because of the war on Iran. The market dropped around 10%, 9%, and it recovered, and it is printing new highs as well. So yes, the market is volatile. The market can drop 30%, 40%, sometimes even more. But if you are a long-term investor, the market always recovers. Okay? So I'm pointing out just to how easy sometime investing can be. Of course, trading, and we're going to cover what is trading, what is the difference between trading and investing. Investing is much easier than trading because all you have to do is buy and hold. You aim for long-term gains in the assets, in the value of the assets you purchase, while trading is basically trying to benefit from all these price swings. So you see the market goes down, you want to buy, it goes up a little, you sell, and you try to buy at a lower price, and so on. Of course, trading requires more experience, more knowledge, more discipline, requires money management skills, but you can learn all these slowly, not in 1 hour webinar. But if you are serious, you can always keep learning, and I'm going to guide you on how to do that by the end of this webinar. Now, commodities. A lot of traders and investors are not only interested in stocks, they like to invest in real commodities, such as gold, silver, other metals, oil, grains, and commodities are basically raw materials traded globally. They are essential inputs for the global economy, energy, manufacturing, and production. Unlike stocks, they do not generate income. So if you buy a stock and the company makes some profit, this company will distribute the profit on its shareholders. And what we call these, we call them dividends. Now, if you buy gold, gold does not generate any income. If you buy gold, you can only benefit if the price of gold goes up. So you buy at a price and you hope that the value of gold goes up so you can sell at a higher price. But while holding this commodity, it will not generate any income for you. Unlike a property, if you buy a property, you can rent this property and generate a stream of income. If you buy a bond, this bond will pay you coupons or interest. If you buy a commodity, commodities do not generate any income. Prices are mainly driven by supply and demand dynamics. We're going to go deeper into commodities. So basically, commodities are divided into three main sectors: agricultural commodities, energy, and metals. When we talk agricultural commodities, we refer to grains, food and fiber like corn, coffee, soybeans, cotton, but also livestock and meat like cattle. When we talk energy commodities, we are referring to crude oil, Brent oil, natural gas, ethanol, propane, and so on. And when we refer to metals, we have industrial metals like copper, lead, zinc, and also precious metals like gold and silver. So these are the three main types or categories of commodities: agricultural, energy commodities, and metals. And my favorite market, the FX market, the Forex market. The Forex market is the market where currencies are traded or exchanged for one another. Now, any of you here already participated in the Forex market? Any of you traded Forex before? I'm sure you did, even if you don't know you did, because every time you travel and you exchange your currency for another in the airport, you have participated in the FX market. As I said, the FX market is the market where currencies are traded or exchanged for one another. Now, the FX market is the world's biggest market. It's the biggest market with an average daily turnover exceeding $6 trillion. And this market operates 24 hours a day, 5 days a week, from Monday to Friday. So anytime during the week, from Monday to Friday, this market is open. Unlike the stock market, which operates around 7 hours, 8 hours per day, it depends on the market. Some markets even operate less, 4 or 5 hours. The FX market is 24/5. So 24 hours a day, 5 days a week. You want to trade, you can. The FX market is an OTC market used by individuals, financial institutions, businesses, and governments. FX transactions occur because of international trade, because of tourism, borrowing and lending, and of course, speculation. Today, most currencies are freely floating, and their price is determined based on the demand and supply of each currency. Currencies are usually a stable investment, so the value of a currency does not fluctuate a lot. And especially currencies that represent developed economies. So if you take the dollar, for example, if you open the chart of the euro against the dollar, you will never see the euro going up in value 300, 400%, like the stock market or like gold. Why? Because the euro is priced against another developed economy currency. So you are evaluating, you are giving a value to the euro against another currency. And if both currencies represent developed economies, it is very hard to see one currency going up multiple times against another currency. Of course, we are not talking about emerging currencies, emerging economy currencies, because that's another story. I'm going to show you a little bit the daily turnover of currencies. So back in 1998, the daily turnover of the FX market was around 1.7 trillion. So every day, 1.7 trillion uh, was exchange hands. In 2005, the amount went up to 2.2 trillion. By 2007, we crossed the 3.5 trillion. By 2015, we recorded 5 trillion daily turnover. And by year 2024, we crossed the 6 trillion mark. So imagine $6 trillion worth of FX trading happening every single day. Now, this is around 4 or 5 times the global stock market value. So this is 5 times the volume of all the global stock exchanges combined. Why? Because central banks, governments, international companies, and corporations, they participate in the FX market. The FX market is the money market, okay? It is where you exchange money for a currency for another currency. So think about every single company. When it wants to buy products, it's exchanging its currency for another to pay for these products it is importing. Also governments, also banks, also you as individuals, let alone trading and speculation. And we have the derivatives market. The derivatives market is where you basically trade financial contracts that derive their value from underlying assets. Derivatives are basically divided into two categories based on the assets they derive their value from. So we have the commodity derivatives, which are based on commodities. Energy contracts derive their value from commodities like oil and gas. And we have the financial derivatives, which are based on financial instruments like stocks and indices, which derive their value from the stock market or the index itself. Types of derivatives, we have futures, we have options, we have CFDs, which is a contract for difference. Financial derivatives have many benefits, such as margin trading, going long and short, and some being tax exempted also. Margin trading, however, as in all cases, can increase both the profit potential but also the risk, so must be used wisely. I'll talk more about money management and margin trading later on in this webinar. Any questions on what we covered so far before we jump into how markets create opportunities? Guys, if you have any question, please drop it in the question and answer window, not in the chat. I don't think you can type anything in the chat, so please use the Q&A window to drop all your questions. We've been talking about opportunities in different asset classes, Now, let's dig more into this. And I'm going to show you here the power of investing in stocks. If we look here at again, I'm pulling out the chart of the S&P 500, and this time, um, okay, someone is asking what makes a stock price go up or down in the short term versus the long term. Okay, so basically the stock price is affected by macroeconomic factors such as economic growth, inflation, interest rates, the job market or the unemployment. And also it is affected by microeconomic factors, which are factors related to the company itself, its management, its debt, the sales, the growth of the sales, future estimates, and so on. So basically, the main driver behind price is demand and supply. If there is demand for this company and its stocks, the price will go up. If there is no demand, the prices tend to drop. Now, what causes demand to increase or decrease? These fundamental factors I mentioned earlier. So the macroeconomic factors and the microeconomic factors related to this specific company or sector. Now, some traders, this is what makes up a market. Buyers and sellers. Okay. Some believe that the stock price will go up. Others believe that it went up a lot and now it will drop. So some people will buy and others will sell. And this is basically the market. So answering your question, what makes a stock price go up or down in the short term versus the long term? Demand and supply. Demand and supply is affected by our behaviors as investors and traders, speculators, traders, and investors. So traders are basically uh, short-term traders, while investors are long-term. So think about any company. Yes, the stock price can go down in the short term, but in the long run, if this company knows how to run its business, its stock price will eventually go up. Okay, so some traders do not care about the short-term price fluctuations. Others will try to benefit from every single move in the stock price. If the price goes down a little, they want to buy. If it goes up a little, they want to sell and try to buy again at a lower price and so on. So it depends what drivers are causing traders to buy or sell, to decide whether they want to buy or sell. Ahmed, please simplify. I'm trying. I'm trying, Ahmed. Okay. What I will do is I promise you, Ahmed, that if you keep attending these webinars, everything will be clearer. Okay. I know I'm giving a lot of information for someone who's a total beginner or he's just starting to explore the financial markets, which is not very good. But with time, with more topics covered, you will gain more understanding of each of these topics. So I know I mentioned fundamentals, macroeconomics, microeconomics, and these economic terms. What I will do is I will schedule another webinar focused only on macroeconomics and another webinar focused only on money management and another webinar focused only on technical analysis and so on. So we can have enough time to cover various topics because combining everything in one webinar, I agree it's going to be hard for everyone to grasp all this information in 1 hour. Now let's go back. I'll simplifying things, talking about the power of investing in stocks. So again, if you look at the stock market, the US stock market, this is the price. Okay, this is the price of the US stock market. And let's talk about returns. Thank you, Suhail. Thank you, Ahmed. So let's look at this. For the last 5 years, the S&P 500 went up 15% annually. So imagine if last year you invested in the S&P 500, you are earning 15% yearly. If you put your money in the bank, how much are you getting paid in interest? 3%, 4%, in some countries 5%, but definitely you are not earning 15%. So for the last 5 years, if you invested in the US market as a whole, if you bought the 500 companies in the US market, the S&P 500, you are earning 15% yearly. For the last 10 years, you are earning 12% annually. And if you take the last 20 years, you are earning 10%. Now, if you take the last 10 years and put your money in the bank, you are barely earning 2% average per year. While in stocks, you are earning 9 to 10%. So $10,000 invested 10 years ago is worth $31,000 today. $10,000 invested 20 years ago is worth $67,000 today. And we are not taking into account the reinvestment of dividends. I'm not going to complicate and throw a lot of strong words, okay, or complicated words. So the market rewards time, not timing. Uh, I always say that it's easier to make money over the long term by investing rather than trying to trade and benefit from every price move up and down. The market rewards time and not timing. You need a lot of experience to be able to time the market. Okay? So the easiest way to approach markets is through investing, not through trading. Now, markets fall, but yeah, they do recover. So if you take the 2008 financial crisis here, what happened is the market dropped. As you can see, the market dropped. The market dropped almost 50%. So the bottom was reached in 2009, March 2009, but new highs in 2013. So in 4 years, the market dropped and then recovered and reached a new valuation. In the COVID crash in 2020, the bottom was reached in March 2020, new highs in August 2020. So in less than a year, in 5 months, it took time to recover. It was only 5 months. So look at all this drop here. The market dropped 35% and then recovered all this in 5 months. And then during the 2022 bear market, it took only 14 to 16 months to recover. So when markets drop, this is an opportunity, especially for strong companies. So imagine, I always like to think about it as the market is on discount. So your favorite companies are on discount. The same like when you go to the mall and you find your favorite brands doing a discount, 25%, 50%, Black Friday. When I go to a store and find my favorite brands on discount, I buy them. And this is exactly how you should trade or invest in the financial markets. If you are convinced about the performance of a certain company, okay, and then you see its stock price down, you should do your analysis and you should think, if this company going down because the overall economic situation is bad, and the sentiment of the investors and traders is pessimistic, or is this company in trouble and will not be able to recover? If this particular company is not in trouble, then it's a very good time to buy, because you are buying a solid company at a cheap price. But again, what I told you is stock picking is also risky. Diversification is better. So instead of buying one company, buy the whole market, buy a group of companies, buy multiple companies. Do not invest everything in one sector. Buy some tech companies, buy some utilities, buy some airlines, buy some banks and financial companies. And then you will have investment in different sectors. Buy gold, because gold usually is a good hedge. So when a crisis happens, what happens to the price of gold? Usually the price of gold goes up. So basically, what happens to your portfolio? The stocks are going down, but gold is going up. So this is another hedge. You hedge the stocks in your portfolio by another asset class, which is commodities, gold, and so on. Looking at some extreme winners, and of course, you don't need a lot of those. You just need few of them. Take Nvidia, for example. The last 5 years, 1,500% growth. The last 10 years, 10,000% growth, 100x. So imagine you invested $10,000 over 10 years, it's $1 million. From 10,000 to 1 million in just 10 years. If you take Apple, for example, who doesn't like Apple as a company? Who doesn't like the products of Apple? I mean, I'm an Android. I'm a Samsung guy. My phone is Samsung, but I also like Apple. So even those who don't own a lot of Apple products, they like Apple as a company because it proved to be successful. So in the last 10 years, an investment of 10,000 in Apple is worth more than 100,000 today. If you take Tesla, 200,000. And if you take Salik, which is a UAE company, it IPO'd in 2022 at a price of 2 dirhams and reached a high of 7 dirhams. So in 3 years, it went up 215%. Opportunity is not only in the US, it exists locally and in different forms. In every market, you see these unicorns, we call them, successful companies who start at one level and then they grow exponentially. Now, another thing to consider is not only capital gain or the value of the company. You should also consider the power of dividends. Take Coca-Cola, for example. Coca-Cola paid dividends for the past 60 years. And it even increased its dividends for more than 50 consecutive years. Coca-Cola as a company is already everywhere. So in every country you go to, there's Coca-Cola. And everyone drinks Coca-Cola, right? So the growth potential of this company is somehow limited. It's not like technology companies that they are still growing and expanding. Coca-Cola is already established. It's everywhere. Everyone drinks Coca-Cola. So the value of the share will not double or triple in a short period of time. However, this company earns a lot of profit. So because this company cannot expand anymore, what it does, it distributes these profits to the shareholders. So imagine $1.8 to $2 per share annually is distributed. So if you take the stock price of Coca-Cola today, you are earning around 2.5% return every year. from dividends, from profit distribution. The stock is up since 2009. The stock is up more than 330%. So in 16 years, the stock is up 330%. This is, forget about the 330% in capital gain. Look only for the dividends, 2.5% yearly. That's passive income. Add to it the 330% increase in price. So it doesn't take much. These are historic returns, and we are not covering 2, 3, 5 years. We are talking 60 plus years. Gold. Now, gold has a different role and a different strength. Gold returns, if we look at the last 5 years, we are talking about 70 to 80% return. If you talk about the last 10 years, it's around 100%. And for the last 20 years, we are talking about 450, 550%. So a $10,000 invested in gold for the last 20 years is now worth $55,000. Stocks provide growth, gold provides protection. Gold might not make you rich fast, but it helps you stay rich over time. For me, as a financial analyst and as a consultant, if I get asked what is the best combination of assets to include in a very simple portfolio, I would say 50% stocks, 50% gold, and you are good. Half of your investments should be in stocks and the other half in gold. Of course, you should keep some cash. So if we talk about in the amount you want to invest other than cash. So let's say if you have $10,000 and you want to invest, keep 2,000 in cash for future opportunities and put 4,000. I put 4,000 in stocks and 4,000 in gold. And I'm going to teach you in our next webinar, I'm going to teach you the dollar cost averaging strategy. And this is the best strategy for a not very well experienced investor. Now, the difference between investing and trading, as I told you, investing, focus on long-term growth. It benefits from compounding over time. It requires patience and discipline. Investing is growing your capital. Trading, on the other hand, it focuses on short-term opportunities, benefits from volatility. Prices go up, down quickly. We buy and sell, sell and buy and sell, trying to make small profits from every price movement. It requires consistency and risk control. And if you don't have risk management, you cannot be a trader. Trading is working with your capital. Investing is growing your capital. The goal is to understand when to use each. Of course, if you are not yet experienced, my advice to you is not to focus on trading. Start investing and learn how to trade. Once you are capable, once you are comfortable, once you tested your skills, only then you should go and start trading. But your first experience should go into investing. It's easier, it is safer, and mostly, guys, you will earn the same return, okay, with less effort. Again, thank you everyone for joining, and looking forward to see you in our upcoming webinars. Ciao.